Machine learning is a powerful tool. It allows computers to learn from data without being explicitly programmed for every single task. Think of it as teaching a computer to recognize patterns, just like we do. You can show it thousands of pictures of cats, and eventually, it learns what a cat looks like. In the world of finance, we don't use pictures of cats. Instead, we use data. We feed the computer historical stock prices, news articles, economic reports, and market trends. The machine learning model then learns the complex relationships hidden within all this information. This ability to learn from vast amounts of data is what makes it so valuable for trading. For many years, traders have relied on their experience and intuition. They would study charts and read financial news to make decisions. This approach has worked, but it has limits. A human can only process so much information at once. The global financial markets, however, generate an incredible amount of data every second. It is impossible for any person to keep up with all of it. This is where machine learning comes in. It acts as a tireless assistant, capable of analyzing massive datasets in real time. It can spot subtle patterns that a human trader might easily miss, providing an edge in a very competitive environment. Using machine learning in trading is not just about making more money. It is also about protecting what you have already invested. The markets can be very unpredictable. Prices can change suddenly due to unforeseen events. A political announcement or a natural disaster can cause a stock's value to drop rapidly. Machine learning helps us build systems that can anticipate these changes. By understanding the patterns that often come before a big market shift, these models can provide early warnings. This gives traders a chance to react and protect their investments from significant losses, making the entire process much safer. The goal is to shift from reactive trading to proactive trading. Instead of reacting to a market crash after it has happened, we want to anticipate the possibility of a crash and take protective measures beforehand. This is a fundamental change in how we approach financial risk. Machine learning models can be trained to identify conditions that are similar to those that preceded past downturns. They can analyze market sentiment from social media, track unusual trading volumes, and monitor global economic indicators all at once. By bringing all these pieces together, machine learning offers a more complete picture of the market, helping us make more informed and careful decisions. So, what exactly is a predictive model? In simple terms, it is a machine learning system designed specifically to protect your investments. Its main job is not to find the next big stock that will double in price overnight. Instead, its primary function is to identify potential risks and dangers in the market. Think of it as a smoke detector for your investment portfolio. A smoke detector doesn't make your house more valuable, but it provides a crucial warning that can save you from a disaster. A predictive model does something similar for your money. It constantly watches the market for signs of trouble and alerts you when it detects something wrong. These models work by learning what normal market behavior looks like. They analyze years of data to understand the typical patterns of price movements, trading volumes, and volatility. Once they have a solid understanding of what is normal, they can easily spot anomalies. An anomaly could be a sudden, unexplained spike in selling pressure for a particular stock, or it could be a subtle shift in market sentiment that suggests growing fear among investors. These are the kinds of signals that often precede a price drop. A predictive model is trained to catch these signals early, giving you valuable time to act. Building a predictive model involves a clear objective: minimize loss. We train the model on historical data, specifically showing it examples of market crashes and corrections. We teach it to recognize the specific set of circumstances that led to those negative events. For instance, we might feed it data from the 2008 financial crisis or the 2020 pandemic-induced crash. The model learns to associate certain patterns, like rapidly increasing volatility or a sudden drop in investor confidence, with a high probability of a market downturn. This way, the model becomes an expert in recognizing the warning signs of financial trouble. The beauty of a predictive model is its objectivity. Human traders can sometimes be influenced by emotions like fear or greed. During a period of market panic, it can be difficult to think clearly and make rational decisions. A machine learning model, on the other hand, does not have emotions. It follows the rules and patterns it has learned from the data. It provides an unbiased assessment of the risk based purely on evidence. This can be an incredibly valuable tool, helping traders to stick to their strategy and avoid making impulsive decisions that they might later regret. It acts as a calm, logical partner in a volatile world. Let's consider a simple, practical example of how a predictive model works. Imagine you have invested in a technology company. Your model continuously monitors data related to this company and the broader tech sector. It analyzes not just the stock price, but also news articles, social media posts, and even regulatory filings. One day, the model detects a sudden surge in negative news stories about a key supplier for the company. At the same time, it notices a small but unusual increase in the number of people selling the stock. Neither of these signals alone might be a major cause for alarm for a human trader. However, the machine learning model sees things differently. It has been trained on historical data and knows that this specific combination of events, negative supply chain news coupled with insider selling, has preceded a 15% price drop in similar companies 80% of the time in the past. The model immediately flags this as a high-risk situation. It sends an alert to the trader, suggesting a protective action, such as selling a portion of the shares or buying a protective financial instrument. This is not a prediction of the future with 100% certainty, but rather a powerful, data-driven warning that the risk level has significantly increased. Another great example is detecting a flash crash. A flash crash is a very rapid and severe drop in stock prices that occurs in an extremely short time. These events can be triggered by a single large, erroneous trade or a sudden wave of automated selling. They happen too fast for a human to react. A predictive machine learning model, however, can be designed to monitor the market's order book in real time. It can spot the signs of an impending flash crash, such as a sudden disappearance of buy orders or an overwhelming cascade of sell orders. It can then automatically execute a command to pause trading or sell your positions before the loss becomes catastrophic. These models are also excellent at understanding market sentiment. Sentiment analysis involves teaching a machine to read text and determine if the tone is positive, negative, or neutral. A predictive model can scan millions of tweets, news headlines, and forum posts every minute. If it detects a growing wave of fear or panic among investors, it can signal that a market-wide sell-off might be coming. This provides a broader view of market psychology that is impossible to get by just looking at price charts. It helps you understand not just what is happening, but why it might be happening, giving you a deeper insight into potential risks on the horizon. The importance of protecting your investments cannot be overstated. For many people, their investments represent their savings for retirement, their children's education, or their future financial security. A significant loss can have devastating consequences. Traditional trading methods have always carried a high level of risk, and many people are hesitant to enter the market because they are afraid of losing their hard-earned money. Machine learning offers a way to manage this risk more effectively. It provides tools that can help even novice investors make more cautious and informed decisions, democratizing access to safer trading strategies. By focusing on risk management, machine learning makes trading more sustainable. The goal is not to chase unrealistic profits, but to build wealth steadily over time while minimizing exposure to catastrophic losses. Predictive models are a key part of this philosophy. They encourage a disciplined approach to trading, where decisions are based on data and probabilities rather than gut feelings and speculation. This shift in mindset is crucial for long-term success in the financial markets. It helps traders stay in the game, avoiding the kind of major setbacks that can force them to stop investing altogether. Ultimately, integrating machine learning into trading is about making the process smarter and safer for everyone involved. These models serve as an advanced early warning system, constantly scanning the horizon for potential dangers. They can identify complex risks that are invisible to the human eye and provide the necessary time to react defensively. This does not remove all risk from trading. No system can do that. However, it provides a powerful layer of security. helping to shield investments from the market's most volatile and unpredictable moments. It empowers traders to navigate the complexities of finance with greater confidence. In summary, machine learning is transforming the world of finance by offering powerful new tools for risk management. By building and deploying predictive models, traders can better defend their capital against sudden market downturns and unexpected events. These systems learn from historical data to recognize the warning signs of trouble, providing objective, data-driven alerts. This leads to more disciplined, proactive, and ultimately safer trading decisions. As this technology continues to evolve, it will play an increasingly vital role in creating a more secure and intelligent financial future for investors at all levels.